Pattaya City Expats Club is a non-profit social organisation and our speakers are volunteers. The club as such assumes no responsibility or liability for the professional reputation of or the quality of services provided by the speaker today.
All good.
Good morning, everybody.
So first of all, just thank you very much to Les and for George and all the people involved with the Pattaya City Expats Club for allowing Mark and myself to come in today. It's going to be a very sort of simple overview, basically, of what we do. I'm aware that, financial services and, there's a lot of different aspects to this out there, and there's a lot of people that, are in contact with you, and you see a lot of marketing, and it's just really giving you a quick sort of overview of what we do in very simple terms. After that, of course, if there's anything you'd like to discuss personally, then we're available, both Mark and myself, to have those conversations. And also, as we go, please feel free to ask questions as we go. I want it to be as interactive as possible, and then we can hopefully, all get a bit more out of it than we hoped. So, what have we got here then? Okay, I apologise. Thank you for the feedback. Okay, no problem. Okay, all right, good. Okay, thank you for that. Okay, so the name of the presentation today, as you can see, is Expat-Focused Investment Vehicles. And as I mentioned earlier in my introduction there, it's going to be a very brief overview of the types of vehicles that are available and, how they are a benefit to certain people. So this is a little bit about who my business is, who is Tenzing. Tenzing Pacific Services is the name of the business. And we've been around since 2012. And we have offices here in Thailand, in Bangkok and Pattaya, and we have one in Ho Chi Minh City in Vietnam. Now, we're not a huge company. As a brokerage, what we do is we act as middlemen between the client and the provider. So that's what we do. And we have terms of business with around 40 different providers, both in health insurance, life insurance, and financial services. So as you can see, we're not an enormous business. We've got about 2,000 clients in all. Most of those are health insurance clients, about 140 corporates, and about 1,500 individual clients. And as I mentioned, we have the offices based in Southeast Asia, which is where the majority of our client base is. And there's me. So a little bit of background on me. I'm a chartered accountant by trade, and I'm from Jersey in the Channel Islands. I'm sure most of you Europeans are familiar with Jersey. It's a small island in between England and France, and very much a financial hub. Probably 90% of the business which is generated in Jersey these days comes from finance. So my background before moving to Thailand was as a trustee, working in corporate services in Jersey. So therefore, preservation of wealth is utmost. That's my background. That's what trustees do. We make sure that wealth is conserved. I've been working in the business for 30 years altogether, Jersey and then here, and I've been working with Tenzing as a director and partner since, I've actually been working with Tenzing since 2018, and I've been a director and partner since January 2020. And this is my colleague Mark, who I'll let introduce himself.
Thank you very much, Craig. Just got to Thailand this year, actually, and sorted everything out and joined Craig. It's taken 4 years, right? I was here in 2018, and
we all know what happened next, don't we?
Yeah. So banking is my background, and I had 25 years in Lloyds Bank on the SME, small and medium enterprise businesses, so as a business banking manager. Now I'm a member of the Chartered Insurance Institute and the Personal Financial Society from the Midlands in the UK, which is where I worked, and servicing businesses in the East Midlands, Nottinghamshire and Derbyshire. Came out to Asia after one of the 4 Ds, divorce basically. So after a long marriage, I got back in touch with a friend, and so that's my story really. I won't go into details. And I'm based in Pattaya, but often go to Bangkok to see clients.
Just on that note there, although you can probably see it on our website, it's not on the cards, the Pattaya-based office, we do have a small office down in Soi Chayapun, which I'm usually in Mondays and Tuesdays, and you can find Mark there most days of the week as well.
So, it's basically a simple talk. We're going to be looking at the basics of regular savings plans, lump sum savings plans, and pensions.
Yeah, I think so. I think it's important just to differentiate, the types of products that we offer. And, in very simplistic terms, you say regular savings is what it says on the tin, every so often, whether that be monthly, whether it be quarterly, you allocate some money into an investment product with the intention, of course, of getting growth over a specific time frame that's unique to you. The lump sum is what it says on the product. You put a certain amount of money in, and I think pensions, we all understand what they are. They're, contributed by employees and individuals, and they offer you protection when it comes to having financial stability once you reach a certain age. Here's just a few examples of the providers that we use. As I mentioned earlier, there's over 40 providers that we have a term of business with in the health insurance and the investment businesses. On the investment side, probably round about 15 that we use, although of course there are some that we find better than others. And here's just an example of a couple, a company called Dominion. All of these companies are registered and regulated in strong offshore financial jurisdictions. So, for example, Dominion is regulated and based out of Guernsey. RL360 and Ardan are both out of the Isle of Man, and Moventum is out of Luxembourg. So, of course, what this offers you is not only a tax-efficient way to invest your monies, but also the expertise of many years in developed, well-regulated offshore financial jurisdictions. So that's a key, I think. If ever you're, in discussions with people and they talk about using companies, and there's a lot of businesses out there, maybe based out of Bermuda, Mauritius. Some of them may be very sound, but we're a firm believer in using what we call the top tier of financially well-regulated jurisdictions, because it simply offers the client much more protection than some of these other less highly rated places. So, a regular savings plan. I guess the question is, why would you want to enter into one of these? One of the big factors, of course, here in Thailand is that there's no statutory rules. I know certainly in the UK, most developed countries in Europe and the States, there's a statutory requirement for your employer to make a contribution towards a pension fund, which you'll be able to access at 55 or 60 or whatever the age is. Superannuation in Australia, I think it's 9 to 10% of people's wages that have to be allocated into a pot for the future. In Thailand, we don't have that. So therefore, people that are working and earning, they have to replicate that in some way. And they do that by entering into one of these savings plans which we offer. So that's the first point there. Why do you need it? I guess it's like everything in this world. People need a safety net. Life events happen all the time. You might want to buy a house. You know, kids here, as you know, international schools, very expensive, international universities. These are all factors which require large amounts of investment, and the only way to have that ready is, of course, by saving it. No return on cash in the bank, which means, especially in the current environment, even here in Thailand, I think we're experiencing about 5 to 6% inflation. Over in US and UK, as you know, we're in double digits when it comes to the inflationary environment now. So therefore, if you're in a bank account earning 1% a year, you're losing 9% in real terms. So, of course, getting a return by getting it into the markets is an important aspect with your savings. And what we call dollar cost averaging. I don't know, is anyone familiar with that term? Yeah? It basically means putting money in on a regular basis so as that, you know, when the markets are low, you're benefiting from getting, you know, more units of investment for your money. And over a period of time, whether it be 5 or 10 years, you're going to lessen your risk by putting a little bit in every month. And again, these types of things, I mean, if you don't want to say right now, more than happy, myself or Mark, to sit down, have a chat with you on a one-on-one afterwards. We're going to be around for the next, you know, for an hour or two after the presentation's finished, or make an appointment and come and see us. So, and yeah, just basically retirement planning, financial independence. Okay, do you want to do the next one, Mark?
Yeah, what's the Provident Fund? Is it a law in Thailand that was passed?
It's, again, it is a fund which is offered by some employers to some expats and foreigners who are working out here, but it's a relatively limited underlying investments, the Provident Fund. A lot of it is Thai stock exchange, and I'm not saying that Thailand is a bad stock exchange, but I think we all agree that longer term, you know, having some more solid currencies, and more importantly, when you reach retirement, diversifying your savings through currencies in more developed countries, then you know, that's going to give you a better balance, and ultimately it's going to give you you know, a safety net. I mean, you ask any Brit who was on a fixed pension pre-Brexit, you know, he's getting £3,000 a month on his pension, he's getting 60 to the pound, suddenly that drops to 45. You know, a huge amount of his spending power has gone overnight because currencies are volatile. So having a setup whereby, you know, you have some US dollars, you have some euros, you have some pounds maybe, and possibly some income in local currency is all very, very important to hedge yourself longer term. And again, just things like you know, the well-regulated tax-friendly jurisdictions that I spoke about before, and of course access to a very wide range of funds and you know, opportunities depending on your risk profile.
Yeah, different sectors, different geographical areas, and so on, including that.
Yeah, that's it. You know, I mean, I know it's a bit cliched, the eggs in one basket scenario, and you'll hear certain people like Warren Buffett make comments like, you know, over diversification is only for people that don't know what they're talking about. There's an element to that, but that said, you know, you still shouldn't have all your eggs in one basket. I think we know that, and again, it's case by case. So I'll just fly through this quite quickly because just looking around the room here, I'd imagine probably lump sum investments are more of interest than the regular savings, but they offer sort of 5 to 30 years. Again, you look at the client's risk profile, what works for them on a payment frequency basis, whether it's monthly, quarterly, or annually, how much you can park. You know, they're not expensive. They start at just $200 a month. And, you know, also just looking at the provider's options with the client and finding what works for them. Do you you have any comments there, Mark?
Oh no, just the final thing. It's from the top there. We look at the whole situation of the client, so we're not just looking at one thing and pushing one product. We're looking at the whole situation and just finding out what is most suitable. Then we get to the application at the bottom, and we just do our due diligence, our research for clients, and then it's just the paperwork afterwards. And payment methods already been mentioned.
Yeah, I mean, they're very straightforward, really. I mean, you simply fill in an application with the credit card and, you know, every month, whatever you want to go into the market goes in, whether it's $200, $500, $5,000, whatever works for you. So a lot of this is going to be a little bit repetitive because, of course, you know, whether you invest every month or whether you just have $100,000 that you want to invest in one go, a lot of the aspects remain the same. Of course, cash in the bank, whilst we're in an environment where interest rates are set to rise, it's certainly going to be a long time before the banks pass that on, and the days of getting 4%, 5%, 6% on your cash are still a long way off in my view. So again, to beat that inflationary environment, you have to be finding ways to grow your savings, and the products we offer do it in a tax efficient way. When it comes to lump sum investments, a lot of retiree clients of ours out here, of course, are interested in income. You know, I mean, the key thing is that when you stop working, you want to be able to continue to live the life that you had when you were working and have the same access to the same level of income and the same level of lifestyle. So having products which generate income, and unlike the savings plans, where if you take the funds out before the term is up, there's costs. With any lump sum, there's no locking period. So it's very simple. If you've got $100,000, you invest that through a platform in one of these jurisdictions like the Isle of Man or Guernsey, and then we decide on the risk appetite, buy some good funds and get some growth. Open architecture, what that effectively means is that you have access to a very wide variety of assets, of asset classes, as Mark said, as geographical locations. You might think, okay, this area, ASEAN, very positive on the growth story here. You might want to buy some funds that invest there. You might favor a particular sector of the market, such as healthcare or renewable energy. And again, there's such a wide range of assets and funds which you can buy in those classes that we can provide you with the right diversification. Portable. All of these products, again, are designed for the expatriate, with a few nuances, such as relocating back to the United States can be a bit tricky. But generally speaking, if you were here in Thailand, resident, and you decided to go and live in Vietnam, or you decided to go and live in South Africa, then generally the products we offer are truly portable, and you can take them with you. Just another thing as well is the penultimate point there about access to institutional share classes. When you're buying assets through these platforms, then you have access to the cheaper share classes which the institutions buy, which you couldn't do if you were just going in as an individual. And whilst tax is somewhat of a minefield and everybody's situation needs to be looked at in isolation, generally speaking, all of these platforms offer a favourable tax. It's not, you won't get overly taxed, shall we say. Process, really very similar to the savings plans. I mean, everything that we do is based around understanding what your goal is, and one of the biggest aspects there is is time frame. Time frame is so important. You know, if you've got an all equity portfolio and you're going to need access to all that money within a year or 2 years, you're in the wrong place. You know, you need to make sure that you have the right level of risk based on when you're going to need access to that money and how long it is to grow. Risk profile, obviously amounts to invest. Liquidity requirements, very important. As mentioned, especially for retirees, you know, you need to make sure that you've got the money in the bank to do what you want, to enjoy yourself, and you know, having the right liquidity is important. And once again, just like the other ones, although we do have quite a lot of regulation with these account opening documents and various proof of address and passports and certifying and source of wealth and this, you know, it's still a relatively straightforward process given what you get at the end of it. Do you have any other comments there, Mark?
Just an expansion on the risk profile. Risk is just your attitude to how much you're willing to invest in certain categories. So if you invest in stocks, say, that's a much higher risk than, well, I was going to say bonds, but these days, and cash. Cash is not not a good investment at the moment, but liquid, I suppose.
Yeah, I think most of you in the room probably understand the basics of that, right? That equities are generally, you know, the higher risk sort of area, and then you have bonds, which are kind of next, and then of course cash and treasuries, and you know, obviously risk and reward are of course correlated, although as I keep saying, we manage that based on your time frame. Go on. It was a point, and that's why I think I did mention that. Oh, of course, yeah. Yeah, I think you know, today the brief was more about, you know, introducing, you know, us as a business and trying to give an overview of what we do. I mean, I understand that, you know, the regular savings probably isn't as relevant to a lot of people in this room as something like a lump sum. I mean, to sit down and talk about products available for retirees, you know, I could talk till the cows come home. I mean, there's that many different options out there. But like I mentioned before, you're talking about income, are you? I suppose for retirees, you want income, yeah, yeah.
But
no.
But I've already been speaking to people who are thinking about their own children or people friends they know that may want some regular savings plans too. So but we respect that comment, yeah.
Yeah, no, I think, I mean, the key is, of course, you know, I'm sure it's like a lot of speakers you get here, you know, we can't go into every detail of every single aspect we do, and the idea is that we introduce ourselves, and yeah, please come and see us or hang around afterwards and get an appointment, and then we can talk about it. I mean, when it comes to income producing vehicles, I mean, if you want a very brief overview, there's a few derivatives we work with, which, you know, were underwritten by big companies like Goldman Sachs and Morgan Stanley, which offer very little issuer risk and can pay you sort of round about sort of 5 to 6% a year, albeit not with a great deal of liquidity on the capital. There's also, you know, higher risk, less regulated opportunities where you can buy into businesses, which will pay you a double digit. Obviously, those businesses are vetted by us, and whilst we can't, you know, wholeheartedly guarantee that nothing will go wrong, you know, we've been using them for a number of years and have the confidence there. So the returns are out there. I mean, you talk about an income often. It's quite funny because, you know, a lot of guys on the street, you talk about a double-digit income, like 10% a year, and immediately they get defensive. Oh, well, if it's 10%, it's got to be very high risk. When you're dealing with institutions and you're dealing with high net worth individuals, you tell them you're getting 10%, they say, go away, come back when you can get me 15. So, you know, the mindset's different. So the opportunities are out there without doubt. As I say, it's not the platform here because, number one, we haven't got time, and two, you know, it's there's quite a lot of detail to it to go through individual options. But absolutely, I mean, if you're looking for an income. As I say, 5%, we can find some fairly safe products that will do that, and some double-digit returns for those willing to take on a bit more risk, because risk and reward are correlated. Alternatives, generally higher risk. There we go, mentioned there. Derivatives, I mentioned before, sort of 5 to 10%. Corporate bonds, the corporate bond market's been a bit of a tricky one in the last few years to understand, because it hasn't followed suit what it used to do 10 years ago when, with interest rates and equities. But ultimately, if that's the client's, requirement to get lower risk and he's happy just keeping up with inflation, then obviously the options to do that are out there. I know I'm going backwards here because we started talking about alternatives, but if we look at managed funds as well, which are growth funds, there's always the argument about whether or not actively managed funds are better than ETFs. And again, it's discussions to have on a one-on-one basis with the client, and just make sure they have an understanding. So here's an example of what you might get depending on your mandate, as we say, i.e. your risk profile on a portfolio. So the one on the left is higher risk because it has a higher exposure to equities, as you can see. And the one on the right is lower risk because it has a higher exposure to fixed interest. The one on the left would be called a growth mandate because, of course, it's looking to obtain higher growth but willing to take on more risk. And the one on the right would be balanced, which means that they're pretty much supposed to be around about 50-50 with equity and bonds. And a lot more cash, as you can see on that one there. You got any further comments on that, Mark?
No, really, it's absolute return. You can have sort of an ideal mix for different clients. So you get that's fairly low risk on the right, although there's still 26% in equity. It's fairly low, and that is quite high. So that in the middle we can do a variation of that, say 50-50 in equities and the other investments.
Yeah, again, I know it sounds like I'm beating the same drum, but it is so important to understand that it's all about, it's all about you and your risk profile and what you want to achieve and how much you're prepared to take on when it comes to capital risk. So that's, as I say, a very sort of brief overview, and happy to talk about specific vehicles and options on a one-on-one basis. But as well as people's own money, which is invested either regularly or in a lump sum, we also work with pensions, predominantly in the UK, although I've been involved in one or two in mainland Europe before. And this may be of interest to some of you guys out here. If you're retired, if you were working in a certain area for a while, you may have had an employer paying the pension for you. You don't know where it is, or you don't know exactly where it is or what it's worth. This is a common situation. One thing that we can help with is we can find out, where that money is, perhaps consolidate 3 or 4 and move it into a vehicle which will enable you to manage it yourself with our help. One option of these is called a SIP, which stands for a self-invested personal pension. And again, it's just getting back control of what's yours, basically, because I think a lot of people will have that, and it may only be a few £1,000s here or a few £1,000s there, but, it all adds up. Do you have a question? Oh, sorry. And then, again, something, before the Brits in the room, this is something which may be something which I do a presentation with a more specific British audience, because it does only apply to people who are a UK domicile, and I don't know how many of them are in the room now, but the British have a terribly penal inheritance tax, which means that when you die, even if you'd been living overseas for decades, if you haven't taken the right steps to lose your British domicile, which is based on where you're born, the cost of that to your beneficiaries and your kids and your grandkids is enormous, because the threshold is only £325,000, and everything over that, the UK government kindly comes and takes 40% in tax. So, you know, even an estate of £1 million, you know, £250,000 could be gone from your beneficiaries if you don't take steps to make sure that that's negated. But again, that's a very specific issue, and as I say, I would definitely welcome anybody who thinks they're in that position to come and have a chat, because there's often a misunderstanding between domicile and residence. People think, oh, I've left UK 30 years ago, I'm no longer domicile. That probably isn't the case. And whilst in the past, possibly the UK government, HMRC, hasn't really gone after these monies, I think we all know the position the world's in at the moment, and people that are overseas residents that are still domiciles are easy targets because, you know, they're not taxpayers, they're not voting, etc., etc. So again, that's something which is specific to a certain group of you here. But yeah, please do look into that, because there'd be nothing worse than, you know, your kids thinking they're picking up a £1 million estate, and then by all said and done by HMRC have got their hands on it, it's only worth 600,000. So.
That's right. I think it also applies to anybody with property in the UK if they're from abroad. So you could have a possible liability for inheritance tax if you're from abroad out of the UK, and at the moment you've got an allowance of £325,000, and anything above that is taxed at 40%. So that can be quite horrendous.
Yeah, very true. Again, probably maybe not the audience here, as you brought up before, but if you have you know, locals who own assets in the UK, then that also falls under the inheritance tax you know, bracket, and owners of that will pay. And again, we have solutions for that if that's of interest. So yeah, it's a penal tax, and it's not going to get any better. And as I say, it's very, very important that you plan for that if your scenario could end up being that your beneficiaries lose a big chunk of your hard-earned wealth when you go.
Okay, that's the end of the actual presentation. There's our contact details. There are our contact details. And there's the address. It's Soy Pothole in Pattaya. If you want to come.
I did laugh actually, because obviously we all know with you know, the new rules around you know, cannabis, and obviously that being called pot. I saw a place called the Pothole or something on there. I wonder whether that's you know, those two factors are gonna see us full of you know, weed shops down there. But it's yeah, I mean, as I say, I mean, we're here. I mean, we're here to chat. We're here to speak to people. You know, we recognise that you know, financial services in Pattaya has, you know, sometimes, you know, got a bit of a bad name for itself. We know that it happens whereby, you know, there are, like any industry, people who do not act in the best interests of their clients and act in the best interests of themselves. And unfortunately, somewhere like Pattaya, it is easy for those characters to exist because there is a lack of regulation. That said, if you do come and speak to myself and Mark, hopefully you recognise that, you know, number one, we have the levels of qualifications to undertake this job. We're all legally set up. We deal with regulated entities, and you'll be able to see that, you know, whilst no one's got a crystal ball and no one can guarantee to make you money, you know, that everything that is done through, you know, businesses and providers which offer the investor and the client security. So just something to consider then. So where are we all? So we got any questions? What's the thoughts? Any thoughts? Anybody got any thoughts on the stock market or where their portfolio is or what they want to do? Do I bring this over?
Yeah, hi. Yeah. I'm officially ex-domiciled. I filled out all the paperwork. I am actually officially ex-domiciled. Would I still be liable for inheritance tax on my assets in the United Kingdom?
Well, yes. I mean, the inheritance tax blanket effectively covers all assets that are physically in the United Kingdom, which again, like by holding assets in a platform like the Isle of Man, means that that's being moved across, and also, as I mentioned earlier, for a UK domiciled individual, they're global assets. Yeah, I mean, again, with the greatest respect, it's such a strange sort of, there's so many different ways they try to trip you up. I mean, you're talking about domicile or residency? Have you actually got the domicile, a letter from a lawyer saying that you're non-dom UK? Okay, I mean, I think it's, you know, I'm not, it's a very grey area, this, and at the end of the day, if you have lived overseas for a long time and you have no ties to the UK, then there's a chance that, you know, you have met that criteria of being non-domiciled, okay? That said, in law, there's been some cases of aspects such as, you know, someone still having a magazine subscription, a golf membership, this type of thing, which takes them back to the UK. And at the end of the day, you know, HMRC, you know, they're going to kick the tires. If it's going to be worth it for them to chase it up, they will. And even if you have a letter from a lawyer and you have like full confirmation stating that, you know, in their opinion, you are a non-domiciled individual, if HMRC see a case of going after it, they still will. You're not even offered complete protection there. The only aspect you're protected from by having this advice in writing is if there is interest that accrues on any outstanding debt for IHT, you don't have to pay that interest if you've taken the appropriate steps and got like a legal opinion on your domicile status. So, you know, either trying to take a domicile status into Thailand, which is a talk that I might be doing with BDO Thailand in the near future, or utilizing one of those products like we mentioned before, such as a QNUPS, would be certainly safer ways of being 100%, well, you can't be 100%, but safer ways of being more certain that, you know, your domicile is definitely not the UK. Because the thing is, if your domicile is not the UK, is your domicile here? Yeah, I mean, again, that's not your personal situation, probably look at, but it's, you know, you've got to have a domicile somewhere, right? You can't just be a non-domicile anywhere. Yeah. Yeah, I mean, domicile is tricky, and as I say, I think one of the difficult things which people understand is residence. Residence is fairly straightforward. You stay in a country for 180 days in a year, or whatever the laws might be. You become resident. You're liable to capital gains and income on that, and then domicile is different. So, sorry, did you want to?
Yeah, well, I had a couple of questions. One, I assume if he says he's ex-domiciled, he is. It's very difficult to become ex-domiciled. You have to completely cut off your ties with England. I'm talking about UK now. Now, with classification, we're talking about inheritance tax, which is 325,000. If you give anything above that to charity, it's completely free of tax. So if you have £1 million, for instance, you can give all to charity. You pay no tax at all. If you pay over 10% of the money that your inheritance to charities, your tax comes down from 40 to 36%. So that's other ways of
mitigating
your worldwide assets. Yeah.
Yeah, excellent. Yeah, no, thank you very much for that. And you know, whilst it's been a number of years since I've done my exams, and I'm not going to turn around and say that I know the exact options there are for mitigating tax now. We work with a network of advisors in places like the UK that when the person's individual circumstance was looked at, we would then reach out to them and they would be able to rubber stamp advice such as that. So yeah, I mean, it really is a very, very strange, they talk about places like Thailand having all these grey areas which can trip you up. I mean, the situation with UK domicile is just as bad, if not worse. I mean, I was chatting to an expert the other day, and he was telling me that, like Australia, for instance, is a popular place that IHT, they'll go after IHT because there's no IHT in Australia. In fact, they have to have a referendum to change it. Of course, if you have a country which has IHT in place already, then HMRC aren't going to get the whole lot, right? Because there's double tax agreements. So therefore, they go after people who are domiciled in countries with no inheritance tax. And Australia is an example of one of these. And one of the chaps was telling me, and this guy is an expert, he actually was involved in writing the residency rules for HMRC before he became an independent advisor. He was saying that if somebody made their fortune in New South Wales and then they went to retire in Queensland, just by moving state, by the letter of the law, that can re-trigger the guy's domicile of origin again. So, all these like little areas where you can trip up are out there. And so, I think it's just always worth every so often. Obviously, you don't want to throw money at advice for the sake of it, but at the same time, just checking where you are just in case, But yeah, I mean, if you want to contact, we'll do that when I do the BDO talk at, I think it's going to be at the Pullman in a few weeks' time, then maybe come along to that, and that'll be a lot more specific about both UK domicile and possibly shifting it to Thai, because as I say, you've got to be domiciled somewhere. And the inheritance tax, I'm no expert on this, but the inheritance tax here is considerably less. I think it's something like 50 million baht, and then anywhere between 5 and 10%, not £300,000 and 325 and 40%. Okay, good.
Any more questions, anybody? Oh, go down there again.
Thanks. You were talking about the derivative products for income. I was just wondering if you could tell us which ones are the ones that are appropriate for the people in the room here. Which derivative products are appropriate for the people in the room here?
Okay. It would be easy if I had a sort of be able to draw this out, but I don't know. Have you heard of structured notes before? Oh, right. Okay, cool. Yeah. So I mean, generally, structured notes which are derived from the performance of indexes are areas which I invest in for clients, because the risk, obviously, of an index volatility is less than stocks. So essentially, they're also purchasable through the platforms that we talk about in the Isle of Man and Guernsey, underwritten by people like JP Morgan, BNP Paribas, Goldman Sachs, so very, very little issuer risk. And I think, again, I don't want to sort of dodge it, but to try and sort of explain how a structured note works from start to finish, it's a little bit tricky for me to do that in here. I mean, you get it, right? You were involved in the actual working for the bank, writing the products, right? Yeah, okay. Well, I mean, of course, and as you know, so basically, very, very simply, on what we call observation dates, whether they're every 6 months or 3 months or annually, as long as indexes are at a certain level, you're guaranteed an income. And as I said, that income is guaranteed by a substantial business like a Barclays or so it's structured notes mostly is our derivative book.
Just to add to what you said, also the underwriters of the things that we assembled were also JP Morgan, Barclays, and these banks, but they were also guaranteed, but there were delays in settling those products when the liquidity started to go down. So again, I'm just asking which ones do you think are appropriate for the people here in the room?
I mean, as far as as you would know, being in the business, I mean, the banks are issuing these on a daily basis. So, as far as sitting down and choosing one one particular note that's out there is not something we can do right now. I mean, when I deal with the note providers, you have all the back testing data on that. And what that back testing data will provide is it will go back, whether it's 6 years, 8 years, something along those lines. And it will illustrate that by buying a note similar to this, which may be correlated to the Nikkei, the S&P, some well-developed indexes, that the likelihood of default or what's happened in the past is 2-3% or whatever it might be. So looking at that backdating or that what do you want to call it, back testing data, that certainly, although of course the past doesn't guarantee the future, it definitely gives you confidence of the likelihood of something going wrong with that. As far as delays go, I've not seen it so far. Again, as we know, we're in a tricky economic environment at the moment, and there are aspects to any finance instrument which cannot do as it says on the tin. But as I say, we use providers.
I think you'd agree that we couldn't really generally say for everybody in the room. It would be specifically for an individual, really. We'd look at the situation, what they're looking to achieve, and take it from there for different types of asset classes.
I mean, it's very difficult, to get a return. I'm sure you'll agree with this as well. And liquidity, right? You've got to sacrifice liquidity for yield in this current environment. I mean, there are options around. There's a few fund managers that I deal with who would buy high-yielding investments, and there's one or two that actually ring-fence them dividends. That's another area which can generate an income. But as Mark says, it's about sitting down, understanding the product, understanding the risk, understanding the return, and if you're comfortable with it, then you go for it. And you look at things like the backdated data. Getting my words mixed up here. The back tested data. I mean, what other sort of products did you get involved with?
I worked with something called Delta 2s, which are 2 levels layered above the primary product. And everybody in our department, we were responsible for getting rid of, through repackaging, all of the assets that the bank didn't want on its balance sheet. So we use mathematics to try to minimize the risk exposure, but and still preserve yield. But really, those were institutional products. Where other parts of the bank used the marketing elements to distribute those to smaller investors. But they were very, very complicated, and they were only for institutions. But about probably 2/3 of the volume ended up in private individual portfolios.
This does happen for sure. I mean, there are what we call sophisticated investments out there, and the client has to understand what he's doing when he takes on a sophisticated investment because the risk is higher. That said, some of these products, if you look at what they've done in the past, and you look at who's underwriting them, and you look at the requirements for the interest or the coupon to be paid, it can be the risk can definitely be seen as relatively low. But as we said before, everything's correlated. The higher the risk, the higher the return. Good question. And as I say, this gentleman here would have a much deeper mathematical understanding of the products themselves than myself. I just, as I say, rely on what I see these have done in the past, understanding what it takes in order to ensure the client gets an income, understanding the issuer risk, and also making sure that that I've seen the people that are providing these have a good track record of getting things done the way they're supposed to be.
I'm wondering if we've got any more questions. Anybody?
Okay, I'd like to thank both Mark and Craig. If you'd want to come up, I want to give you a certificate of appreciation. Everybody put their hands together for... Everybody wants to know where to park their money if they have any money left, but anyway, we'd like to thank you very much.